In last video, we have built a multiple linear regression model for the price change of SPY and find the model is not overfitted by comparing adjusted R-squared and RMSE in trend and test datasets. In this video, we will use predict price change of SPY as a trading signal and perform a simple strategy. If the signal is positive, we will long, otherwise we will short. First, we will compute position of our trading based on our predict value of a response. Order equal to 1 if predict value is positive, or our prediction for price change is positive from opening today to opening tomorrow. Otherwise, order equal to -1, which means we will sell 1 share if we have 1 share and short sell 1 share. Daily profit is computed in columns profit. Finally, we can compute accumulated profit and save it in the column of wealth. Total profit in these 1,000 days is $170. Then we can compare the performance of this strategy, which we call the signal-based strategy, with a passive strategy, which we call buy and hold strategy, which is to buy 1 share of SPY initially and hold for 1,000 days. We can see from the plot, signal-based strategy outperforms buy and hold strategy. Similarly, we can build trading in test dataset and the total profit is 130, a bit lower than that in trend. Signal-based strategy also outperforms buy and hold strategy in the test data. The consistency of performance is very important, otherwise it is too risky to apply it in the future. Average daily return is a measure we can make comparison. In finance industry, many use Sharpe ratio and maximum drawdown. Sharpe ratio measures excess return per unit of deviation in an investment asset or trading strategy, named after William Sharpe. For example, daily Sharpe ratio is equal to the mean of excess return divided by standard deviation of excess return. Since there are about 252 trading days per year in US stock market, the yearly Sharpe ratio is equal to daily Sharpe ratio multiplied by square root of 252. To compute the Sharpe ratio, we first need to revise wealth process by including initial investment, which is the price of 1 share of SPY. We will use log version for return process. Yearly Sharpe ratio is 2.04 for training data and 1.18 for test data, which is much lower than that of the trend. Maximum drawdown is a maximum percentage decline in a strategy from historical peak profit at each point in time. We first compute drawdown and then the maximum of all drawdowns in the trading period. Maximum drawdown is a risk measure for extreme loss of a strategy. To compute a drawdown, we need to compute peak of wealth process. At every time point, we can do it easily using data frame method, COMMAX. We find maximum drawdown in trend and test are very close. The result shows that if we apply this strategy in test set, the maximum loss from the peak is 9%. From the measure of a Sharpe ratio and maximum drawdown, we can tell that the performance of strategy is quite consistent in terms of extreme loss, but the return per unit of risk is not very consistent. In this topic, we have explored linear regression model mainly from perspectives of statistics. We demonstrate the application of linear regression model in SPY trading. We conclude that the derived model is not overfitted and the performance of signal-based strategy is consistent in terms of risk of large loss. It is promising to further develop it into a profitable strategy, but they may cost a lot of efforts. Although the fees ratio of SPY trading is very low, the bid-ask spread is a hidden cost for this strategy and may eat up all profits. But it is not the objective of this course. In this course, we demonstrated that with adaptive learning skills in Python and core concepts in statistics, we can explore the real finance problems by interacting with the real data.